Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so risk markets finished the week pretty strong. ISM services came in slightly better, but not enough to prevent a sharp rally in stocks and in bonds. Europe and China also outperformed on the week. We had China up 6%, Europe up 2.5 to 3, and the VIX got slammed back below that 20 level, all the way down to 18.5 in VIX spot. Commodities also having a good bounce, helped by China PMIs coming in better than expected. And oil was pretty choppy as we saw some OPEC headlines there, but it did finish higher on the day and on the week. Vols were hit pretty hard. You can see here, second. So you can see vols, 3.5 vols lower in S&P. That's pretty punchy on the week. Also, European vols getting slammed back down to a 15 handle. So just a pretty big normalization in vol across the board, as the S&P failing to break down below that key 3,900 level, and protection was dumped back onto the market. As we saw skew come down as well, you can see skew back into the kind of 15 to 16 percentile, 15 to 20 percentile range after hitting around 40 to 50 percentiles the previous few weeks. China and Nikkei vols holding in better, only down around 0.5 point compared to those US and European vols. And commodity vols coming down as well, pretty much across the board, with the likes of Nat Gas down 10 vols on the week. That strong rally that we saw on Friday eviscerated all of the positive carry. So you can see not a lot of positive carry anywhere to be seen except for FTSE, which remains still in positive as that thing realizes an 8 vol and implies around 11.5. But you see European markets actually in negative carry there, as those sharp rallies actually doing pretty well versus an implied vol break even of around 1% a day. Okay, so that's kind of what we saw across stocks and commodities. If we go to FX, we can see that the dollar, not huge moves, but it did pull back a bit. It peaked up at highs at the start of the week and gave some of that back as those yields reversed on Friday. Those funding currencies of yen and Swiss, which have lower interest rates, obviously, they were weakening on the yield differentials throughout most of the week, but then they also reversed sharply on Friday, and it ended the week slightly better against the dollar. Bonds had a really, really strong reversal. TLT there up 2.5%, which is a 2 sigma move on the day. So, you know, after popping its head below 100, managed to recover strongly after that ISM, and HYG kind of following suit up nearly 2 sigma as well. And then in terms of the sectors, really led by the commodities, XME, metals and mining up 10% on the week, energy up 3% on the week, and then high growth tech actually doing okay as well, with that bond rally up 5% on the week. Looking at other things, you know, vols lower across the FX space, down about half a vol approximately across all the names except for Brazil, which was bigger. But we do think that vols are now starting to look a little bit better value across FX. We were seeing a sea of green in terms of positive carry across FX, thinking that it's really not worth touching these FX vols, and you're starting to see the likes of Euro and Cable moving into the red, also Swiss, also CNH. So quite a few of these currencies now starting to move around a bit, even though the dollar hasn't really shaken off this 104 level on DXY materially. But heading into the big macro catalysts that are coming with the likes of non-farms, CPI, FOMC over the next 2 to 3 weeks, we think FX vols are starting to present a potential opportunity to start picking things up. Okay, moving on. So many economic data prints keep beating. Okay, and inflation expectations are rising on the back of that. So the narrative on inflation is definitely shifted over the last month. The rates market has repriced aggressively the likely path of rates for more hikes and for higher for longer. Expectations of that Fed funds rate for December 24 have shifted by as much as 120 basis points. Pretty punchy. And the effective terminal rates have hit highs of 5.5%, which is above the rates that were projected by the FOMC in December, where they were seeing rates at like 5 to 5.25. So the next meeting on the 22nd of March has become a massive deal because it's going to give the market more clarity on how the Fed plans to react to the recent data that we've seen over the last month, with so much more sort of, you know, the jobs market still looking tight, the inflation numbers re-accelerating to the upside. What are they going to do about it? We still have two huge data prints coming, non-farm payrolls on the 10th this week, and then CPI next Tuesday on the 14th. And at the same time, the Fed is going to be in blackout. So they're not going to be able to respond and react to those data points and give the market any guidance. So that could lead to potentially more volatility as well. Inflation out of Europe has also been printing hot. And despite an extremely hawkish ECB, the five-year inflation expectations have hit record highs. This is something that Alf put out in his latest. So 2.6% on these five-year. And usually these correlate pretty well with oil prices. And we're seeing oil languishing down there at local lows, whilst we are gapping higher on inflation expectations. So an interesting divergence there that he's pointing out. The global spike in inflation expectations has also taken real yields down. That's the green line here. That's dropped by about 20 basis points recently. This is the US 10-year real yield. And that has triggered a strong bounce in gold, which has taken gold from around 1805 lows last week at the start of the week up to around 1850 where it is today. So the question this poses is gold a better alternative to long bonds right now, given that inflation expectations are starting to run to the upside and maybe they are dragging absolute yields higher, but we're seeing real yields actually turning down. Okay. And then if we look at commodities, the big swings in oil. So obviously the news flow was that Saudi Arabia and the UAE are clashing with OPEC. And we're talking about leaving OPEC. That was denied very quickly. And whilst we did get that sharp intraday drop in Brent crude all the way down to sort of 82.5, it did recover and it did actually finish the day higher. Now, looking at this story a little bit more closely, if we look at the UAE oil production and their estimated capacity, their production's here in the low threes. Their quota is around 3, and their capacity is around 4.2 million barrels a day. So the question is, are they getting annoyed? Apparently there is a rift growing. Are they getting annoyed with OPEC and they want to be allowed to produce more because they do have that spare capacity? So markets, to some extent, okay, they recovered back on the denial, but to some extent they need to price in the probability of production increases down the line to appease these guys. Now, our key takeaway, we're not going to take a directional bet on this because we don't really have any edge there, but we do think oil implied vols look quite cheap. If we look at our strategy compass across commodities, it is definitely screening low for most commodities. Oil's no exception, and it's in single-digit percentiles if we look at the implied volatility. So we think just owning some straddles or strangles in oil at these levels, because it's showing its hand to some extent that it really can move pretty sharply and pretty quickly on headlines. We think owning some June expiry straddles or strangles, keep the theta down, but own some Vega because you want implied vol exposure because you think the implied vols have got quite a lot of upside from here because this thing is looking quite cheap. So that's the idea there in terms of spotting where there might be some value in commodities. And then if we look at terminal rates have come a long way since the 3rd of February, which is that big non-farms print. Okay, they were down below 5. They touched 5.5 last week. Now this move, we think it's been quite an impressive move, and we do think it might be worth fading this move ahead of these key data points of non-farm payrolls and CPI. So whilst we're sympathetic to the idea that the jobs market's way hotter than anyone thought, we do think the move in rates has been exacerbated by positioning. We think everyone in the rates market was positioned very short and has got squeezed on this high on this strong data. And we do think some mean reversion in rates is very possible if these numbers don't come out. So whilst we've had this big move throughout the course of February, a move back down towards maybe 525, which was the higher end of what the Fed had basically guided in their last meeting when they had their projections. We think a move back somewhere towards there is very possible. Right now, if you look at the June SOFR futures and the implied rate on those, that seems to track the Fed terminal funds very, very closely. That's the blue line relative to the white line, which is the effective terminal funds rate. So you can see they're tracking very well. So the way we would get optionality on the Fed funds terminal rate is by looking at June 23 SOFR options or options on that futures contract. Okay, so looking at that, what do we see? All right, thanks a lot for listening, and I'll catch you all tomorrow. Cheers.